Juan Vargas is the managing principal at GenWealth Capital Group, a multifamily real estate investment company based in Houston. He started out with single-family investments, and after achieving success and desiring to scale up, he transitioned into multifamily syndications. His first deal didn't come about through some of the typical channels we use in the multifamily space. Moreover, he used a direct mail tactic he learned when he invested in single-family properties. In this episode, Juan shares with us how he sourced his first deal. We talk about a challenge he is currently facing in his business, and finally, we touch on pricing strategy for leasing up new developments. Juan Vargas, welcome back to the show.
Hey, it's my pleasure. It really is. And I was like I was just telling you before you hit the record button, if it doesn't work out this time, then I'm gonna have to meet you in person, man. That's just gonna be my excuse to get out there and meet you right there in person. And we'll have to do an interview just live, face to face,
Yeah.
But it's my pleasure, man.
Yeah, I'm so glad you're able to do this. And I mean, this is actually, I think, our third time just talking, or fourth time. I mean, because we've had calls in between. And I mean, you're doing a lot of great things with real estate. And so, yeah, let's tell our listeners a little bit about your background and then how you transitioned into real estate.
Sure. Yeah, it would be my pleasure. So a little bit about my background. I grew up in Texas, just outside of Houston. 5 siblings. Dad was a welder. He taught me the value of hard work, right? So at the age of 11, we're out there welding and building trailers and doing all kinds of different activities. And he always told me, hey, make sure that whatever you do, you put a lot of effort into it. You work hard. Fast forward to the college days. I decided to go to a technical school because, I didn't want to go through the 4 years, even though I had graduated with honors and, at high school, I wanted to just get ready and work. So I went to a technical school, because, hey, I could work with my hands. I could work hard. That's what I was taught. So I ended up working for BMW, right? And I did that for several years. But during that process, I started realizing that, hey, you know what? I can't do this forever. I can't be 50, 60 years old and I was on the service side, right? So I can't be 50, 60 years old and still out here, because it requires a lot of attention. It requires a lot of focus and a lot of, physical movement, right? Up and down. And so, I started looking for other ways that would, help me create passive income. And real estate was that way that kept popping up for me. Everything I did, every research that I looked at was real estate. And my dad was actually in real estate the whole time as well, right? Even growing up. And he would tell me to buy real estate, but I would always see him, underneath the sink, doing things. And he was a maintenance guy. He was the leasing agent. He was pretty much everything, and that wasn't something that I wanted to, I didn't look forward to doing that, right? I didn't look forward to being underneath the sink and, and fixing this, fixing that, even though I was, working on cars and, working with BMW and different positions at BMW. But still, like plumbing and those type of things, I just didn't really see that. But during my research, I kept realizing that, hey, my dad was right, but he was just doing it incorrectly, right? He wasn't using scale. He wasn't using leverage. He wasn't using other people. He wasn't using the right methods, right? So, I decided to give real estate a try. Was able to, acquire a couple of houses as rentals. And then my last rental house that I had, my tenant, who was a good tenant, he ended up leaving because his term was up. And, I had a hard time leasing for whatever reason, right? And it wasn't, drastically hard. It was, it stayed vacant for like a month and a half. But during that process, I realized that, hey, I was the one that had to pay for the mortgage. I was the one that had to pay for taxes, for utilities, for all these different things, and any repairs for a turn, right? So I realized that, hey, you know what? The money that I had made, or I thought I had made, it went back into it, right? So it just lit that light bulb, and that's when I realized that, hey, you know what? Maybe the right strategy is not just one single family home, because if I'm vacant on one house and I'm 100% vacant, but I have a 10 unit and I'm vacant one unit, then I'm still 90% occupied. And that's kind of when the light bulb, just went off, and I was like, hey, you know what? I'm doing multifamily. I'm not doing single family anymore. I'm done with this, right? So, yeah, I haven't looked back since then,
Yeah, you just reminded me of when you were talking about your dad, like under the sink and fixing things and whatnot. I mean, I remember like my family while growing up in houses that we had rehabbed, and I'll never forget like the first time me actually getting my hands dirty, and I was responsible for ripping up the kitchen floor. That we had to redo the floors, the hard because the house that we had, they had like those, and there was the real hardwood. So we had the hardwood floors that we had to refinish. Man, Juan, after I finished that, I was like, I'm never doing this again. It is way too much. It's like very laborious. Um, but more power to the people that could do it. But you're right. You're talking about the scale and the 10 family, right? And so, how did you get into that?
Yeah, yeah. That is funny your story. Because it is a crazy job. Especially when you're dealing with nasty houses that've been sitting. Just where you had like nasty previous owners, right? That just didn't take care of it, right? I've gone through my share of that, and it's pretty bad, right? But yeah. I started educating myself, like, whenever I had, my last single family house, I started to educate myself on the multifamily side of things. And it was something that looking back to my college days, when I went to technical school, I should say rather, I remember, I specifically remember this, I was looking for an apartment, right, to live in, right, while I was going to school. And I remember, getting off right before I went into the leasing office and thinking, man, you know what? I wonder what it takes to own one of these, right? And then I was with my cousin at that time, who ended up being my roommate, and he said, "Man, why are you even looking at this? Why are you even thinking about this, man? This ain't for you, man. This is some big timers out there, right? Some big companies." And I was like, you know what? You're right. I don't even know why I'm even silly looking at this or even thinking about it, right? But it crossed my mind, right? And fast forward to that one house, while I was going through that process, it gave me those flashbacks of that one moment, right, when I thought about that, and I was like, why didn't I look further into this all this time? It was just a mental thing, right? It was a mental wall, barrier that was put in front of me by somebody else, right? But yeah, I started educating myself, listening to podcasts, reading books, attending different networking events that were specific to multifamily, and just trying to grow a network in the multifamily realm. And one of my ways was reaching out to brokers, but brokers didn't really take me seriously because I didn't have that experience in the multifamily side of things. So I had to figure out a way to get into it without using brokers, because they wouldn't give me the time in a day, right? And that was through direct mail, right? So I made a list, through the HCAD, which is the county assessor's website. Made a list of all the multifamily owners within a certain range, right? And also a certain age of properties. My other criteria was looking for properties that were owned at least 3 years. And the reason for that was because 3 years or more, in my opinion, at that time, they had already gone through their business plan, right? Or most of the business plan. And if they had a 5-year term or even a 7-year term, maybe they were getting ready to sell as well. They're looking at the options to sell. So I didn't look at anything that was under 3 years of ownership, right? It was all 3 years or later. And I just started sending out direct mail, and these were handwritten letters. And I ended up getting a call from a few different owners, and one specifically that I actually went through some of my screenshots on my phone just the other day, and I saw that screenshot that I kept from that owner, which was the first multifamily property that responded to my email or to my mail and said, yes, we're looking into possibly selling. We haven't reached out to a broker yet, but if we do, then we're going to be asking for this price, and if we don't, we're going to be asking for this price. And so my husband is ready for retirement. Let me know if you'd like to have a conversation and discuss a possible transaction. And that was pretty much the start of it, right? So it was a 32 unit, maybe 30 minutes away from my house, and that was the start of my multifamily journey.
Now, one thing you mentioned was with direct mail, and I have to be honest, I don't hear a whole lot of multifamily investors even talking about this. Most people are just like cold calling and working with brokers, right? So with the direct mail campaign, can you tell us a little bit more about that and kind of what your thought process was? And you said they were handwritten letters. So would you be able to give us some insight into kind of like the content, or maybe, I mean, you probably wouldn't know the open rates, right? But like the response rate. I'm
Yeah,
thinking
yeah.
email now.
Yeah. No, that's very good. I think that was a strategy that I used on the single family side of things. And if anybody's listening out there, if you even did any kind of single family, any flips, any rentals, you probably have heard of this, once or twice, in your career. And that's, like yellow letters, just sending all kinds of different mail, right? And so I kind of took that strategy and I was like, you know what, if it works in a single family space, then it may work in the small multifamily side of things, right? And so that's a key word, right? Because if you're looking at 200 units or 300 units, I mean, these are institutional guys. I mean, these are family offices, maybe, they're not going to listen to you. They're not going to listen to a yellow letter and say, hey, I could buy your apartment cash, fast closing, right? They're going to be like, what the heck is this guy even thinking about, right? They're going to just crumple it up and throw it in the trash can. So I specifically targeted multifamily properties that were 50 units and below, right? And that was because I felt that these were maybe the market where these were more of the mom and pop owners, right? Where, they've owned it for several years. And, maybe something happened in the family, or they're just simply tired of managing it or whatever. They're just tired landlords, right? And so, yeah, that was pretty much, the criteria there. And, as far as the content, it was more or less, I don't really do them too much anymore, right? Because now we focus on brokers and broker relationships, and they're the ones that send us deals, even off-market deals. But the content was more like, hello, I'm a multifamily investor or real estate investor, I think is the way I worded it. Looking to expand into this market. We have identified your property as one that we would be interested in if you were interested in selling or something like that, right? And we would like to make you a fair offer. Whatever, it was something along those lines. I can't remember word for word, but it made it to where I made it to where I try to understand what their pain points were, and one of those was I even put on there that I'm willing to also put down non-refundable earnest money. So that was a key word there, where people would kind of open their eyes, because you don't get that in the single family space, right? They get a letter and say, hey, I want to buy your house for 50 cents on the dollar, right? And so the key word there for me was a fair offer. I wasn't trying to get this thing for pennies on a dollar. It was a fair offer at market value or whatever. And I was able or willing to put in, non-refundable money, right? So I didn't put that in every single one of my letters, but I know I did put that in a few letters. And as far as the response rate, I didn't really measure this, to be honest with you, but I did have, quite a number of phone calls and emails, because I had my phone number in there, and I also had my email in there to two different ways of call to action. And so, I had quite a few of those, but I couldn't tell you on the exact number of a response rate, on that.
One of the other thoughts that came to mind, just as a follow-up to this, is you mentioned that they were handwritten. So when you say handwritten, like you actually wrote out these letters, or did you have because I know there are services out there that can provide the handwriting, I guess, for it. So which one did you wrote them out yourself?
Well, I used both. The services was my kids. My oldest. I had them writing letters, but I quickly went away from that, because you could tell it was a kid's handwriting, and so I wanted these the owners to actually take me more seriously, right? And then I want them to see a kid's handwriting versus an adult's, right? And mine's like not that great, but you could tell it's an adult's, right? And so I think for me, the reason why I did the handwritten letters versus maybe printed, or whatever, was because I wanted it to be personal, right? So I wanted it to be where whenever the person opened that letter, and it was just an envelope, right, with had my address or whatever, It wasn't my personal address. It was a PO box or whatever, right? And so it was just handwritten on the outside, handwritten on the inside. And so like that, whenever they opened it, first of all, you're curious to see what like, who the heck is this guy? Like emailing or send me a mail piece of letter. And so they're going to open it. The chances of them opening it are very high. Once they open it and they see that it's your handwriting, and you take the time to actually write this to that person, it means more to them versus something that just printed and they just throw it away, right? So I want it to be more personal than anything else. I didn't have like a logo at the bottom, any of that, right? And I also made sure that I found out the owner's name. I think that was very important for me because I don't want to put Dear ABC LLC, right? Because most of these properties are owned under LLCs, right? Are entities. And so I did my research in finding out who that owner was behind that entity, and make sure that I put Dear John, right, instead of Dear ABC LLC. I think those little details are they were very important looking back, right? And as well as the handwritten part, because there would be days where my wrist was just hurting because so many letters that I wrote. But that's what it took, right, to get into that first deal. Mm-hmm.
Yeah, I was going to say, it's definitely it's quite. I remember my first mailing. This was like many years ago, but it's quite a bit of work there. Just writing all those letters. But I mean, for you, it paid off because you got responses, but but more than just responses. You got the deal. You got, what was it, 32 unit? You said, right?
I got a 32 unit.
Yeah.
Yeah, which was that first deal. One other thing that I was able to gain from this. And that, that people, we're looking for deals, right? So we're looking for that transaction, right? But I think is the relationships that I was able to build too. So one was with that seller of that property. Another was with another who's a good friend of mine now. And he's been in the business for, I want to say maybe 30 years, right? He owns, 1,000, 1,500 units. By himself, right? It's all by himself, right? So he ended up being a person who I talked to, a good friend of mine, and so he invited me to his house, right? And I'm talking about the second person, not the seller, right? The property that I bought, but this other guy, he invited me to his house, and he was telling me a lot about the business, right? And we became very good friends. And one of the things that he also showed me, because he invited me to his office, he opened his drawer and then he was like, "You recognize this?" And it was a letter that I sent him. And and this was after so many different visits, right? He still had the letter, right? So I thought that was very interesting, that he kept that letter, right? And, I guess he valued the relationship. I value the relationship more than I think he did, but it was just pretty awesome that because of a letter, we became friends, right? So that's the other thing that people need to be open to, right? You're not always going to get a deal, but sometimes just that relationship that maybe some advice that you can pick up or just somebody to talk to about the multifamily space.
Mm-hmm. Yeah, and I like how even though with direct mail, I mean, it's like realistically, the response is like really low in general, right? But I like how you still basically, in this case, you definitely went the extra mile because you're handwriting everything. And you did that. And you see the response, like the examples that you gave and everything. And there may be a lot of people out there that might just say, "Oh man, that's just going to be too laborious. I'm going to have to do like 500 a week or 600 a week, And they'll say, "Oh, I'm just not going to do that. I'd rather just go ahead and print out something, and or use like one of those third-party services or something." But then the thing is, it's like, what's going to be the difference in your response, right? That you get if you're sending out some canned, paper that looks very fake, essentially, versus like you sending out these handwritten notes, very different.
And like I said, I'm not sure if that's what made the difference, right? But I tried to put it in there, certain things like the name of that person. So I made sure that I found the name as best possible. And I made sure that I tried to understand their pain points. Nobody's looking to do a fire sale, right? If they don't have to, right? So don't expect that, right? make sure that it's a win-win situation, right? They're getting a good price, and you're getting a deal, right? And so I try to make sure that you have the specific language in there that you're not trying to do highway robbery or anything, So that's very important. Whenever you're doing a transaction, you got to make sure that it's like that, right?
Mm-hmm. Yeah, yeah. And so, what would you say has been like one of the most challenging aspects so far for you in your business?
So I would say it would be deal flow. We're talking about that. I think it is deal flow. I think mainly because pricing has been up there, right? So it's hard to make the numbers work, right? All while being conservative, right? You can make deals work all day long, right? But are they really deals? And that's the key question there, right? And so making sure that they work, while on a conservative underwriting, in good markets. So I think deal flow has been a challenge. Good deal flow, right? We get deals all the time across our desk, and we underwrite them, but they don't always work, right? So I think that's a challenge. I think sometimes equity could be an issue, right? Or challenge. I wouldn't say an issue, a challenge, right? If you're looking at larger deals, but we've been able to be successful, with our deals, so which we're very grateful for. But I think those are a couple of things. But just trying to change your strategy as well, right? We've been in an upmarket, for so many years. You can't really say that today in today's market, right? Here we are in 2020. Are we at the height of the market? Are we headed the other way? So trying to understand what the market is doing. Not that you can maybe adjust your strategy a little bit there is can be a little challenging as well, right? Because nobody knows what's happening next, right? We just don't know, right? So that's a few different things, right?
Mm-hmm. Yeah. And speaking of, that with regards to deal flow, one of the thoughts that came to mind in how you're talking about the changing of strategies and whatnot. So one of the things that I'm hearing and seeing other investors do is some are kind of transitioning over to development, especially with the COVID. So, they have that period where it's that development or construction period of 12 to 24 months essentially. And, given that we're not really expecting rent increases. So, I mean, that kind of works out right now, right?
Mm-hmm.
So that's one aspect. And the other thing that I'm seeing across the board right now is a lot of, there are many multifamily investors, especially those that typically will go out and syndicate, 200 unit plus, that are actually looking at kind of smaller properties right now, like in or around the 50 unit range. And they seem to be like, the numbers seem to be working out there, at that level. So what exactly are you seeing? Kind of like what range or what aspects, or how are you guys? Because deal flow is a challenge, right? But then again, it's like that's something that has to be overcome to really keep the business growing. So for people out there listening, where are you seeing the opportunities right now? The ones that do pencil out.
Yeah, that's a very good question. I think so. We've actually come across two deals recently that pencil out. One of those being an off-market deal where the seller has put quite a few work into it, quite a few dollars into the renovations on his property, and he's just simply looking to exit because his debt, right? Mainly because of his debt, right? And so I think that if you are able to find situations and opportunities where the seller is, I wouldn't say in a bind, that's not what the right word, but they're on a maybe on a time crunch, there's a limitation there, then it can work a little bit more in your favor, right? If they have no reason to sell whatsoever, then why would they sell? The only reason why anybody would sell is if you're offering top dollar, right? Like super top dollar, right? Then okay, I'll sell, right? Or I'll consider selling. But if they're not in any stressful situation, then they're not going to be is it may not be as favorable to you. And I think on this one that's working out that we're working on, it's something similar to that, right? So there's that. I would say that, and then the other one is very similar as well. But this is a newer construction deal, right? And so I think that the key is when you're looking at deals, don't just look at the numbers, but understand the situation, understand as much as possible on the other side, right? If you're a buyer, understand as much as possible about the seller as you can, right? Without giving too many of your cards, right? It's, poker, I guess you can say. Try to find out as much as they can. Find out, what kind of card they're holding, right? And if they're holding, a 3 or 4 or 5, then that gives you a little bit more leverage, right? And because you know what situation they're in. So this other deal, it's a newer construction deal. Actually, it's a new construction deal, and so we're looking at that one for that very reason, right? The seller, he needs to get out because of his debt. So the two very similar situations. One was on a bridge, the other one's on a construction loan, right? So two very similar deals. One's class C, C-ish deal, a C plus deal. The other one's a brand new class A development. So, that's what we have seen here lately. And I'm not saying that's the only way to get deals done. You have to be a little bit more creative, I think, than the traditional on-market deals that everybody and their mama sees. And you have to compete with 20, 30 other guys for that same deal.
Mm-hmm. Yeah, and on the point of the newer construction deal that you mentioned, so you said kind of a couple of things actually. So number one, is the construction complete, or you guys would have to do that? And then number two, essentially, it's like you're coming in and saving the developer basically by helping them get out of whatever debt obligations that are coming up, and then you guys are essentially going to take over.
Yeah, it's a very good question. So this is a newly completed deal that is in lease up, right? So there it's only been a couple months of lease up. So that, for us, there's risk, right? Because we also know that, we have to understand what the market is doing. We have to do a market research, like a deep market research, right? To know where our rents can be, right? Our final rents, because it's heavily in concessions right now because it's in lease up. And even if you get to that stabilized percentage, a lot of those residents are at this property because of those concessions. So then, then here comes year two, and you have to kind of go through that process again, right? Maybe not offer those deep concessions that you offered, but there's still going to have to be something, right? Because these people were just trying to take advantage of that 1 month or 2 months free, and they're basically paying for 10 months or whatever that first go round, the first year, right? And then maybe the second year it's more like a 1 month free or half a month free, right? So there's still some risk there, but this was, to answer your question, this is a lease up deal. It's still not stabilized, but there's debt obligations that, like you mentioned, that they have to be met, for them to be satisfied, right?
A couple of follow-up questions that came to mind. The first one, what you just mentioned with the leasing price and the concessions and everything, I think that's actually a really, really good point. And that reminds me of something, actually a personal mistake that I made. And this was in my other business in Beijing years ago. It was like, in the beginning, because we were trying to attract customers, we're essentially like leasing up our business, per se. We were taking like the Walmart, pricing approach, everyday low prices. And the thing is that what we found was when it came time for contract renewal, it was so difficult to get them up to, the going market rates, and then later on, it was maybe like a couple years later, we changed our complete pricing strategy, and we would start with, like the higher price, and then we would give them the discount, but contracts, everything would have the original, that market price on it. And then we would let them know, okay, these are going to be your concessions, and we have that in writing and whatnot. How do you guys handle that, with your residents?
Yeah. So, this is a deal that, we haven't closed on. So, that's going to be, that's to be determined. But I think, that's a very good question. Something that, we have to get back with our team, our property management team to come up with a good, strategy and game plan. Right. Because, not only is the concessions and leasing, key component here is the renewals, right? Which, it kind of ties into that. But another piece of it is your expenses on the payroll, right? Because you have to have leasing agents that are just, rock star leasing agents. And so your payroll is also higher, right? At least for the first couple of years, right? Until you're at a stabilized, point where you can kind of scale back and you're just kind of more or less cruising from that point. But yeah, those are some details that we need to, for sure iron out if, we are to proceed with this deal.
Yeah, because I'm just thinking, like, take for example, I'll just throw some numbers out there. I remember years ago, I mean, this was back when I was in university, so that was a while ago. So
that was last year, man. Don't
man,
it was last year, man.
Yeah, it was last year. But I remember I rented this apartment, and this was back in Ohio. So let's say it was like, like the typical market rent is supposed to be like $1,000 a month, right? But with the concessions and rental discounts, it came out, I was only paying like about $800 a month. So that's like a $200 a month discount, you figure, right? Mm-hmm. So if all I see, from my perspective, the perspective of the resident, and I just see, hey, $800 a month, that's all that's coming out of my account. And then the following year, I see, we're at $1,000. But then, the next year, everyone else is at like $1,100. You know what I mean? So now I'm up to $1,000, and I'm thinking, why are you increasing my rent 25%? So I'm just thinking about like the whole psychology and everything behind that. That was like the big thing that we found out in our business that people just could not accept. And because of that, we actually ended up losing a decent amount of people. And then that's when we ended up changing, the other way around, where it's like, yeah, this is the sticker price, but here's the discount, but you're still going to be seeing the sticker price. And we're going to remind you of that,
yeah, I think that's a very good point. You have to make sure that you prep your tenant, your resident, whoever it is that's coming in at that certain rate. But it's also why, there's sort of like two different lease ups, right? You go through your first year, and then you go through your second year, because the first year tenants or residents, they're like, forget that. I was able to get it for $800. There's no way I'm paying $1,000, for the same place I've been living at for the last year. And so then you have to get people to get in, to that at the higher rate, right? Fresh bodies, fresh people that don't have that same mentality, that they were paying $800 or 25% discount, So yeah. I think, that's part of the reason why there's a couple of different waves there,
Mm-hmm. Now, my other question I had was with regard, again, with this deal is, what's the financing going to look like for this? Because it's still going through the lease up phase. So it may not necessarily reach the occupancy thresholds and things, for like agency debt and whatnot. So how are you guys planning on handling the financing for it?
Yeah. So if we were to move forward with this deal, it would have to be a bridge, right? Because it's not a stabilized asset. They currently have a construction loan. It's not a stabilized asset. And so the only ones that would be willing to do that is maybe a bank loan or some type of, debt fund. And so, once you are able to have a couple of years, not even a couple of years, but, a couple of years later, once the deal is already stabilized, then you can refi or sell at that point, but most likely refi into a long-term debt, with a agency or HUD or whichever strategy that, is available is best at that time, for the deal.
Yeah. I mean, that would, depending on the interest rate outlook, which we're probably not going to see any increases anytime over the next couple of years. So
I don't think so. I think, what the environment right now is, if anything, we're going to keep going the other direction, right? Going south, right?
yeah.
I don't see anything increasing at this time. But again, I'm not an economist. I'm not, an expert in capital markets. So, that's just my personal opinion from an investor standpoint, right?
Mm-hmm. Yeah. So what else about that deal do you think is just overall appealing, is from, let's say that when you're comparing that deal to some of the other available properties on the market that are similar to that?
Well, I would say, I wouldn't say necessarily similar, right? Because, there's not many, new construction deals that we're looking at. If we're comparing it with maybe a B or a C asset, one of the things that we really like about a new construction deal is that, you have very minimal expenses, right? There's very minimal R&M, I should say, right? Because you're still going to have, G&A, there's still going to be maintenance, but there's going to be higher payroll, those type of things. But, your maintenance is usually lower, right? Another thing is, typically the best way to build real wealth, for all the investors, LP and GP investors is, to hold long term, right? And have a capital event. But I mean, long term is make sure that you're taking advantage of, some good cash flow. And so this will be more of a longer term hold, right? So, a couple years in, refi, then maybe you hold it for another, 6-7 years, something like that. And at the end of the day, 10 years down the road is, 8 years down the road, whatever, is still a class A deal, right? Where you can still sell this thing at a low enough cap rate. And hopefully things have, even appreciated from there. And so, and rents have gone up and whatnot. So you're still able to make a, pretty good return. And so now, yes, it's overall, it can be lower returns, lower cash on cash returns average. But you're also taking a lower risk with a newer asset, right? It's a brand new asset. You're not going to have all these plumbing issues, roof issues, electrical issues. Usually you attract better tenant demographics as well. I would say another thing that we like about this particular deal is the as I mentioned, is the demographics, higher income. So that means higher disposable income. So we're able to add all these other income revenue sources. Then there will be less pushback as well, right? And you try to do that with a C deal, then those are usually workforce housing, blue collar type of demographics, and it can become a little bit more challenging, those type of assets.
Yeah. It's you touched on it already, but you mentioned the holding period. So I mean, it definitely seems as though you guys are going to be holding this for a little bit longer comparatively. Now, I guess you might have mentioned this. I think I might have missed it. But from the returns perspective, like the projected returns for this particular deal, are you finding that given the circumstances, it's not really a distressed, in a sense, like being a distressed owner is what I'm referencing to when I say distressed. Not really distressed, but the owner is in a bit of a situation where they do, like you said, they do need to get out of it soon, right? So more than likely, I'm sure they're willing to negotiate, and probably at a discount, perhaps. So when you factor this in, as well as you factor in with your lease up and the lower maintenance costs and everything, are you finding, like, where are you finding the returns? Do you think they're comparable to, let's say, if you were to buy like a B value add, or what are you seeing right now for the projections?
Yeah, so the returns are definitely going to be a little bit lower. But what happens is on a refi, there's a capital event, and so you're able to also return some of our investors' capital, right? So that's a big plus, right? And then you maintain your position in the deal moving forward, right? So from a return standpoint, yes, usually the Class A deals and we haven't looked at many, so I don't want to act like I'm an expert or anything like that. But from the ones that we've seen, yes, they're going to be lower returns. Then as you're getting at a lower cap rate. Simply that's the reason, right? You may be buying it at a at a 4.5 cap rate or even a 4 sometimes, right? Like super low. And your debt obligations is maybe a 3. So it's just a little bit above that, right? Going in, but that's why there's got to be some value that you can push that cap rate up to 5, 5.5, maybe if you're lucky a 6, something like that, right? After a couple of years, but yeah, there's definitely also risk with them because they're still leased up, and because of the debt that you take on as a buyer, you're not walking into a long-term debt agency, nothing like that. It's still a bridge loan, pretty similar to a construction loan, right? Like that they're doing as well.
Yeah. Now, what would you go back and tell yourself, if you could go back in time and talk to yourself when you're just getting started?
That's a very good question. I would definitely tell myself, and you know what, I think about that, so it's nothing like a question out of the blue, right? There's times where I'm like, man, what would I have done differently, or what would I tell myself? I think, for many people out there, if you don't have a plan, a roadmap, then it becomes challenging, right? Because you can go into your 30s, you can go to your 40s, and you're still just taking it day by day, and you're not really knowing where you're going, right? And it kind of goes. It reminds me of the little quote, and I'm not saying it word for word, maybe, but there's a little quote in Alice in Wonderland, right? That where Alice asked that cat, how was it? She asked him, no, the cat asked her, where are you going? And she was like, I don't know. I don't know where I want to go. And then the cat's like, well, it doesn't matter which way you take, right? Because she was asking about which way do I take? What do I take, this way or that way? And then he's like, well, where do you want to go to? And then she's like, I don't know. It doesn't really matter. And he's like, well, then it doesn't matter which way you take, right? And so I think that if you have a roadmap and goals and a specific plan, and it may not be, item by item and specifically, clear plan, but if you have an overall plan of what you want to do, then it helps you so much better, right? You're able to get to those goals so much quicker. You're able to have a much more clear goals and plans. And well, I guess what I'm trying to say is I would have had a better plan from the very beginning, or I had a plan from the very beginning as a teenager, as a young adult. This is what I want to do. And let me see what I can do to be able to achieve these goals and get there, right? But if you're going through your 30s, your 40s, your 50s, and you're still kind of wandering around, and then you really don't go to too many places, right? So, So without making it too confusing, I would say that have a roadmap, have goals, have plans, and don't steer too off from those goals, those plans, and make sure that you stay on it and you go after it.
What's one book you think has impacted your business?
One book, I would say, I like to read autobiographies, right? And so I wouldn't say there's one book. I like to read autobiographies. Elon Musk, just reading about him, Jeff Bezos, the Everything Store, how he started Amazon, Sam Walton, what is it called? Made in America, how he started Walmart. All these guys, they all have something similar, and they're tenacious. They're persistent. They don't give up. They don't take no lightly, or they don't take no for an answer. And they have big goals, right? They have big goals, whereas people may see that they're crazy, that they're not achievable, but these guys make it happen, right? So I think having a similar mindset to what those guys have. I'm not saying I'm going to be a Jeff Bezos or Elon Musk, those type of guys, or Sam Walton. What I'm saying is just have goals that are big enough to where if you achieve it, then or you get halfway there, then that's a big accomplishment no matter what, right? And just keep pushing as far as you can. Make sure that you have some strong team members around you, and keep pushing, because we're in America, and this truly is a land of opportunity. And if you have your mindset there, then you can accomplish so many big things.
And how can our listeners get in touch with you?
Yeah, they can reach out to me through social media. I'm all over the place on social media: LinkedIn, Facebook, Instagram, Twitter. So they can reach out to me there, and through email as well if they want to reach out to me. So that's Juan@GenWealthCapital.com, or I'd rather not give my phone number, but you can reach out to me through email. I'll be happy to connect with anybody that has any questions, or if you want to build a relationship, and I'll be more than happy to do that as well.
All right. Well, thank you so much, Juan. I really appreciate, us doing this again.
Yeah, no, hey, it was my pleasure. Dion, it was my pleasure. I really do appreciate it. And thank you so much for the opportunity.